Welcome to the Quantum City Initiative, a show about the most important stories, ideas at the intersection of AI, cities, real estate, and the leaders shaping the future of how and where we live and work. Do you save and reinvigorate cities, or are you building new ones?
What is most critical for cities in the future with the sort of AI factory race to work? Sound check.
Good.
All right. EP 19. 2025 is over. I think that's a good thing. Happy 2026, Chase. How you doing, man?
I'm doing well. I'm glad my kids are back in school. Love them to death, but woof, that was a long break.
It was interesting timed with the two holidays. That it was a good 4-week. It was a good 4-week break there with the kids home. It certainly felt like.
Yeah, that was fun.
But hey, we're back. The show's back. Episode 19. We started this thing, what would be 19 episodes ago, 18 episodes ago. We got some good stats we'll run through at the end of it. But listen, it is the fastest growing podcast as of right now. Going from 0 subscribers to 3, that's huge. That is huge.
Yeah, you can't really quantify that with that 0 denominator. So kudos to us and kudos to all our wonderful listeners.
Kudos to us. Well, let's get into it. Today's going to be a fun episode. We'll do a little year in review, talk about some good, some bad, some ugly. We'll talk about some predictions. Not a lot of news to start this year. I guess in the CRE world, there's a lot of news in general, but this isn't a news show. But to kick things off, we'll talk about one little quick hit item. We'll go against the script Justin wrote, which is a bummer for him. Quick hit item. Chase, I want to get your take. President Trump made news this week. We actually talked about this on the show. I don't know what episode, about the trend of large corporations buying single family homes. There's all those memes. You're a meme guy about, what was it? Single mothers negotiating and bidding against the BlackRock and the Blackstones of the world, purchasing all the single family homes. Well, Mr. Trump came out and said he's going to do his best to block corporate purchases of homes. I don't know if it's that easy as far as a tweet or Truth Social, whatever he did. There's certainly a lot of banter about that. What's your take on this? Obviously, it had a pretty big impact on the market. Shares of some of those home purchasers, what was it? Blackstone shed about 6% on the news, but now they're back up. What's your take? Good, bad? What do you think on this?
Well, we talked about this, I think, several times in 2025. And I think we might have made a few jokes about modern day feudalism, that we would all be renting from the two black, followed by rock and stone. I think we were spot on that. I think there's some misalignment with how the system currently works. I'm still trying to parse, obviously, my love for the free market, and then how organized large platforms and institutional money can prevent, I think, what is a core kind of piece of obviously making a functioning society, particularly the American dream, being tied to that, buying an affordable home. Ultimately, the way families build wealth is typically through buying that first home and doing well on the appreciating price of said home. I think there are some things about this I like. When you look at those platforms, obviously they have a lot of foreign money, and I don't love the idea of foreign nations wealth fund essentially owning the homes, and American citizens being modern day peasants renting home from feudal lords from faraway lands. So I like that. But then there's also the pensions and things like that of United States and things like that, where they probably do well on some of that. So I think we need to do a little bit more and wait to see exactly how the policy might be structured. But I think they're driving the right outcome. Obviously, the buzzword in politics these days is affordability. And I think a lot of people think the next election cycle will be won on who has the best story there. I think more ideas on how to make housing more affordable is a very good thing.
I like that. We talked about the 50-year mortgage and all that, 100-year mortgage. I'm in on all those.
Let's try them out, see what works.
Try them out. Let's go for it. All right, let's get into big themes of 2025. So we took a look back on a handful of the episodes. One of the biggest themes, obviously, the AI industrial bubble. And this is a specifically interesting one to talk about, given the shift in this specific market as we kick off 2026. 2025 was certainly the year of AI. Just in general, right? Nvidia obviously had an amazing year. I feel like the stock market was literally just sitting there watching what Jensen was going to do, and he drove everything. But the thing with the software world is it turned into the physical world. There was over 100 billion raised in just H1, almost 200 billion raised in AI investment in all of 2025, which matched all of 2024. 400 billion invested globally in data centers in particular, which is huge. Startup valuations, they hit 17x their 2019 equivalents, bubble or not. Data center capex rose 30% year over year. Sovereign wealth funds put 70 billion into AI infrastructure. We had a lot of these conversations. You made that noise, or whatever it is. There it is. We talked about this AI bubble, but we said it was different. We said it was different this time. It wasn't just software, it was physical. So as we get into 2026, so it was certainly the year of AI in 2025. What's your take on the trend now and where the AI infrastructure is going to go? Are we still as bullish on this asset class, on this market? And if not, where do you think it's going to go in this year now, 26?
Well, I think you know, starting with the concept of a bubble, I think what people were misassociating was they think about the dot-com bubble. And I think the typical example that gets bandied about is pets.com, right?
Yeah.
One of the big losers that went away to die. And software bubbles collapse fast because marginal cost is near zero. So when you build something where marginal cost is near zero, it's easy to go away. Whereas infrastructure bubbles tend not to be a bubble in the sense, it's a little bit more of a normalization of price, right? So like when you build something, think back to like overbuilding railroads. The railroads don't go away. So you have potentially inefficiency in the system and they get repriced. But we're talking about hard infrastructure and they could be overbuilding. But I think what's fascinating, and I think I'm going to go long on the AI infrastructure build out because what we saw in the .com, when you think about the telco build out, was that the application layer was being built essentially ahead of the infrastructure. There weren't that many people who were really onboarded onto a platform. When you think about getting the internet, whether you're wired in or Wi-Fi, whatever, those things needed to come along. And so there was this gap in between of user adoption. From an AI perspective, I think the application layer and the hardware stack are pacing pretty well together. Even just the improvements and the adoption. Let's just take AI and engineering and writing code, right? Like
Mhm.
the difference between, and Toby, the CEO of Shopify, just posted this on X that he has deployed more code in the last 3 weeks than he has in the last decade. That's the CEO of a major publicly traded company. And
That's insane.
the application value seems to be keeping up, right? I
Mhm.
think, if there's going to be risk in this system, I would say it's around change management and educating the broader labor force to maintain that productivity ramp. But the nice thing about AI is you don't need to necessarily learn new languages. You don't necessarily need to do things that you didn't know how to do. Most people know how to text and chat and type and all that stuff. So I think the learning curve is actually much easier. It does involve a
Mhm.
little bit of critical thinking and some creativity and all of that. But I don't know. We could be seeing a smooth path to scale here that would be unusual compared to other major platform shifts from a technological perspective.
Listen, I certainly wouldn't short AI in general. I think there's certainly some hype there. Talk to me a little bit about, so let's talk data centers for a bit and some more of the infrastructure layer, specifically energy and then data centers. So data centers were, like we've talked about, the hottest girl at the party for really the first half of the year. And then that trend cooled off a little bit. Liquidity froze. We did an episode on that. Being long on AI infrastructure, does that mean we're going to continue to see the massive build outs of these gigawatt factories? We're going to have to upgrade our energy infrastructure. What's your take on the data center trend and that level of infrastructure outside of just the artificial intelligence, I guess maybe hardware and software side within inside of companies?
Well, I think a lot of where there's risk in the system here, I think is mostly with the folks that are obviously like the direct players and how they're capitalizing this, because energy obviously can't be ignored. You're seeing from the administration, obviously, a lot of talk around oil in Venezuela and what we're doing to make sure that we're bringing energy costs down. I think one of the important things that, if they're going to stick the landing on this, is that AI in theory should be wildly deflationary, right? It should be bringing down the costs of many things. And so this was the somewhat famous conversation between Elon and Peter Thiel, when Elon at the beginning of 2025 was freaking out about government spending and the debt crisis. And Thiel kind of asked him, like, well, with the robots that you're building at Tesla and everything you're doing in AI, and you keep talking about how people are not going to have to work as much, all that, those two things can't totally be true. If it is that efficient and effective, it's going to be wildly deflationary, and the spending problem isn't that big of a deal. Which side of the coin do you land on? So I think it will start to come down to, do we start to see some of the deflationary aspects of AI's promise, which would help with easing the cost of capital, I think. But I think there's like the two worlds of AI, which is like, all right, we're clearly getting much better at knowledge work. Is it going to start to apply to things in the real world? And if they can do that alongside bringing down the energy costs, I think data center probably gets out of some of that liquidity trap. I do think they need to rethink the ultimately the unit economics of it, where you saw that argument between Michael Burry and Friedberg from the All In podcast, where Michael was talking about the depreciation schedules of your typical like manufacturing asset or something like that. And it sounds like the chips last longer than your typical 5-year depreciation schedule.
Mm-hmm.
A lot of this is accounting. And then a lot of it just comes down to, are we going to bring energy costs down? And are we going to see those deflationary impacts fast enough to, nail this, let's say, in the current administration's timeline?
So we saw a lot of trends with regards to the data center and the infrastructure around, obviously, putting these data centers, putting this infrastructure in odd places. Elon Musk said space, fine. China said underwater, fine. You saw Alaska, you saw other markets, more third and fourth tier markets, I think, take advantage of this. You think that trend continues, or do you think, with your deflationary take on this, do you think the scale of and the sort of our innovation in chips, do you think that scale decreases? We're building these massive factories now. Do they have to be as big as this sort of NVIDIAs of the world and ASMRs and so on continue to build this silicon? What level of scale is needed? Like, I think as far as deflationary goes, I think everything's going to just get more efficient and smaller, to be honest. So what happens to these factories? And will we see that level of build out still?
Yeah. So I can't really predict exactly how much data center, we're ultimately going to need. But what I do believe is that too often people make the same mistake over and over again, which is, we're going to get these efficiencies and we're going to have these problems, whether it's labor issues or what have you. But the reality is, when you think back to the history of the telegraph, the running along copper wire, the maximum efficiency they could get was around 200, 300 miles. And you needed people called relays who would listen to the Morse code and then tap it into the other thing. They figured out how to put a bar in between the two telegraph systems, so you didn't need the person to do the relay. And I'm sure people were like, oh man, we're going to kill relay jobs. And where's this category going? And when you fast forward to today, more people in the world type buttons for their job than just those people who are relays. So I think even if the chips get more efficient and we figure out the liquidity trap here, it's going to create significantly more demand. When things get more efficient, cost comes down and more people can get the benefits of the thing that is more efficient now. There's going to be some blips, there always are, but it might not be this apocalyptic thing that everybody talks about. And just as a good warning, very rarely are bubbles or hard resets wildly predicted ahead of time, right? So I tend to be very skeptical when everyone's calling it. And this is the same thing as the hyperscalers. They're the ones that keep talking out of both sides of their mouth
Right.
about like how it's going to kill jobs. This is the typical God complex of when people build these transformational technologies. They start to think that, man, I need to take care of all these people I'm going to put out of work. And that never happens. We find other ways to work. And there's probably some strategy in shutting the door behind them. Bill Gurley gives that great talk about corporate capture and regulating industries when you have the lead to make it hard for new competitors and all that stuff. He uses the term talking money out of the market, which he said Sam Altman does very well. So I'm a little bit more bullish and opposite some of the apocalyptic predictors out there.
Like that. New year, new you, man.
Yeah.
Real optimism. Love that. Okay, let's talk about commercial for a bit here. So the office market, it started slow, I guess, in 2025. We still were using terms like return to office, gross. Cannot stand that. However, 2025 was a huge year. Let's talk some leasing numbers, momentum, some of the stuff we talked about. Manhattan leasing numbers, almost 25 million square feet leased, the strongest start in 19 years. San Francisco leasing, which was an absolute dumpster fire. California has got its still continuing world of pain there, but leasing was up 47% year over year, pre-COVID levels. Boston had its best quarter in Q4 since 2019. The difference here, trophy leasing. So this is your sort of new category, right? We always had Class A, Class B, Class C, and so on. Trophy leasing, 13% above pre-pandemic levels. So love that. Class A leasing, which was previously the top, still 20% below pre-COVID levels.
Mm-hmm.
Class B and C, 40% below and going the wrong direction.
Yeah.
Okay. Tenant improvement allowances have gone up drastically. We've talked about this. You get over $200 a foot in top markets, New York and Boston. We're seeing that. There's still a bit of distress. However, is this the comeback here that we're seeing in 2026? And if it is, it certainly is. We've talked about the tale of two cities. The data can't be clearer now that there truly is a bifurcation in the market.
Yep. This is the experience gap playing out. We got to pat ourselves on the back. We nailed this one before everybody started talking about the trophy asset boom. I think it was before we even started the show at our last year kickoff. And even before that, we were saying, look, this is going to follow retail. And I don't even really think we need to pat ourselves on the back. Anybody who's paid attention to anything ever in commercial real estate over the last few years, this wasn't a hard one to see, which is that commercial real estate, and the real guy who should be patting himself on the back is Joe Pine, because he wrote the book in 1998. But commercial real estate's just going through the experience economy evolution. And you see it in retail. It's a very, very huge chasm between the winners and the losers. It's a tale of two cities. And you are either experiential. I don't like the term trophy because it's about the building. It's not about the outcome for the user. Experience is about the user. And, ultimately what it's showing is that we don't really have a demand problem. I think there's a lot more demand in office and workplace than people realize. We have a platform problem in adapting to the way that people work and what they're looking for in the market. So my prediction for 2026 is that when we look at leasing numbers, leasing tend to be the leading indicators of capital investment in the category. And I think we're going to start to see a lot of money coming off the sidelines and pouring into updating office to be what people want. I was talking to my pal, friend of the pod, Stu Schiff, who's the CEO over at DivCore and DivCo West, as people know it. And he was saying he was sitting on a panel where every year they do bulls and bears in office as a category. And for a while he was the lone bull. And this year he said they can't get anybody as a bear on office.
Now, is that because everybody's just so tired and exhausted from the last couple of years that they want to just take a new take? Or is this a year? I think it's a year. We're at the bottom. We're seeing transactional volume go up. We're seeing net positive absorption. I love that anecdote. I'd love to see who else was on that panel. I don't know if he told you. I'm bullish on this year, and everything I keep thinking about, again, and certainly talking our own book here, but this is truly the year where that experience gap becomes measurable. Because if you think about everything we just talked about, everything you just spoke about, the gap in trophy to A and to B and to C, the TI budgets going up, all of that can be distilled into there truly is a defined gap, and it is measurable. And that's what's super important. And I can't wait to see the rest of the data play out. I can't wait to see some of the changes. We're seeing, again, massive investments. We're seeing top of the market lease and price per square foot that we've never achieved before. In Manhattan, we have a customer in the Netherlands that is exponentially higher. Their leasing and their price per square foot or square meter over there is exponentially higher, and they are turning people away. And it's simply because of experience. I think that's going to be the mainstream topic this year around commercial real estate. I don't think it's going to be called trophy anymore. You know what I think? Here's my wild prediction. And the show notes are completely destroyed because we're doing predictions in 25 review. So we'll see how that goes. My wild prediction was class A, B, and C gone. Those stupid definitions are gone. They don't make any sense. It's going to be measured by the experience gap. It's going to be measured by the experience score. That's it. A, B, and C don't mean anything. They mean nothing.
Well,
That's gone.
You're gonna have to do some work to make that true, which I like.
I got the time.
I think as I was pouring through Leasing data for people who are not familiar, we bought a company called Leasing, which is the world's leading occupier experience survey and assessment company. And 97% of people who work in a hybrid manner. And hybrid is a range of things, but essentially what they're saying is, even if you're going to HQ or main office hub or something like that, be it 1, 2, 3, 4, even some weeks 5, whatever, work and the economy is just dynamic. Like you're working in multiple locations, you're taking meetings, you're traveling. And I think the platforms that start to act like networks and really turn their portfolios into networks are going to capture a ton of pent up demand that requires flexibility. And I'll say this till I'm blue in the face, but we are the only industry on the planet that considers essentially a whole nother asset class and product line and category, flex, something that's just a shorter contract term. Like that doesn't make sense. Like that's the silliest thing to carve out. It's the same thing. Trophy workspace or experiential workspace should be defined on its features and quality characteristics of how people use it, not on the length of the term. That doesn't make any sense.
I think that that's going to be part of my campaign to get rid of class A, B, and C. I think you're onto something. Let's pull on that thread a little bit around flex. So long-term leases, we know leases in general are getting shorter. Long-term leases probably here to stay a little bit, although I would say that with the AI boom, the traditional folks who had the longer term leases, right? It was always great to get a law firm. It was always great to get an accounting firm, right? They would sign those 25-year deals. To me, I think those are the companies that are going to be the most disrupted by AI, in that there's a lot more efficiency gains and they can probably do a lot more with less people. So maybe that shifts. Talk about flex for a little bit. What are you seeing in 2026 with regards to what the top landlords are doing to address this experiential and flex, and not just sitting there waiting for, what is a 10+ year lease?
Well, I think the smart ones are combining aspects of the traditional model with flex, right? Because the top of the market is it still is going to be hiring people. It still is going to want those people in workplaces probably more often than not that are not just their homes. I think I think the data is in that just sitting in your home all day working and then spending free time at your home isn't really optimal for work and life fitting well together. I think changing environments is important psychologically, productivity wise, all that. So I think employers need to continue to have space, but they need significantly more coverage because 97% are hybrid. And so I think the smart landlords are really getting this, right? They're trying to weave in um, additional spaces beyond the lease space that the tenant company takes. They're trying to weave in another form of a economic unit of a credit. You can use credits to book said extra spaces. I think they're trying to bundle more service and experience, not just the space, into the leases. And if they do this and do it right, they get their cake and eat it too, because they're going to maintain a long-term relationship with the tenant company. They have to let go of their past thinking of this relationship needs to be tightly anchored to one floor or multiple floors or whatever. And they need to start to develop their kind of like business resiliency to maintain the way the industry likes to underwrite, which is obviously a long term commitment, but start to figure out ways that they can accrue that kind of long term economic value over multiple locations.
So when I hear the term relationship in commercial real estate, it's one of the most valuable assets there is. Brokers continue to come to mind, right? Where do you see a shift in the brokerage industry, if any, with regard to the experiential gap becoming measurable, with regards to landlords having much stronger relationships with the tenants? Where do you see any fundamental changes, if any, in 26 around brokerage?
I'll short circuit our prediction section, and I will say that by 2030, one of the majors or mid majors will start to move towards brokerage away from a transactional model and more to a partnership and subscription model. So I think that the job of putting together space is going to be less about the major events where you have these massive transactional fees on large space leases. They don't come around that often, so it's risky business. And a lot of these guys are 1099s, right? And so that kind of provides the downside coverage to the brokerage in terms of when demand dries up and there's not a lot of transactions. And then they get paid exorbitant amounts when the money's good. And it's pretty risky business. And I think what's happening is there's going to be a model where you have brokers that are much more attuned to the business goals of their tenants,
Mhm.
and they're going to be doing more higher velocity type transactions. So, for example, all of the offsite planning, we need locations for specialized training, we need locations for special client events, whatever
Mhm.
corporate events. I think there's going to be a lot higher volume of work, and that's going to fit a subscription model. And I think the first brokerage that kind of nails essentially the combination of occupier advisory with transactional execution is going to start to see recurring fees, which when you look at the stock prices of the brokerage firms, investors love predictable recurring fees over the transactional stuff. I think the first people that internalize that can get a first mover advantage and win pretty big. 2030, 2030, I think it's a thing. And
4-year plan.
if it's not, we'll start it because I think it's obvious.
I like that. Okay, let's go into some 26. Let's go into some predictions. Let's play the stew shift kind of bull or bear game a little bit. Okay, let's go bull or bear on asset classes. Let's talk industrial. Bull or bear?
Industrial, I am going to go bull. I think the current administration is incentivized to keep industrial healthy and strong.
Okay. Bull or bear on a sort of segment of that, data centers, what we're
Bull.
talking about.
Bull.
Bull. Ooh. Ooh.
Yeah. The admin has gone all in on AI infrastructure build out. It's tied to the jobs of construction. It's got, over the last year, we've seen every major tech leader go down and kiss the ring in Washington, D.C. So I think there's real partnership there between the admin, and it's clearly seen as a geopolitical and defense strategic priority. So I think they will help to keep that gravy train running. I don't think they're necessarily
Bull
going to care about the liquidity. They're going to be like, you guys can tough it out.
long-term investment, regardless. Yeah. Bull or bear on retail.
I don't know if I would say bull or bear, but
Lion.
I believe
What are you?
I believe the gap will widen even further between winners and losers. So I think I think there's a strong bull case for experiential retail, because I believe that I think with the tax breaks kicking in, I think with the ancillary benefits of AI to workers, I think with some of the moves around bringing down energy costs, they're trying to get it down to $50 a barrel for oil. I think the consumer is going to do better. And I think if the consumer does better, experiential retail will do better. And I think if you're not running with your hair on fire to get to the experiential side of the line in retail, you're dead as a doornail.
We saw massive stories this year on experiential retail. We talked about surf parks added as anchors to sort of new malls. We talked about youth sports added, hockey rinks and youth sports added to experiential retail. Yeah, I think there's a ton there. I think, okay, let's go bull or bear on single family and multifamily.
What are you?
I don't know. Listen. Here's the thing. I'm going to go bearish on this, which hurts because I recently moved and I gave up my 2.75 mortgage, which is a huge bummer. But
What
I
an
just
idiot.
what an idiot. The Fed is doing their thing. They're cutting rates. The administration, I think, is doing, I think, the best they can to work on affordability. They're talking about obviously preventing these large players coming in and purchasing these assets, which would drive prices up. They're talking about potentially introducing 50-year mortgages, which would lifetime value of the mortgage is obviously a lot more, but monthly affordability would go down, would improve. But my issue is the 10-year is not moving and it's not following these moves. And so mortgage rates aren't moving. And without that, or any massive correction in the asset value and the enterprise value of these assets on the sort of residential side, I think 26 is just another lost year for the residential market.
Yeah, I also think I agree. And I think that, look, talking our own beliefs and philosophy here a little bit, part of our Quantum City Initiative view was that there needs to be a little bit more of a national strategy. And I do believe in competing between cities, but there is still just regulatory morass in a lot of these cities that prevent supply from doing what supply needs to do to start solving some of the housing issues.
Yep.
I do not agree with our friendly new mayor in New York on just about any of his tactics on how he thinks he's going to bring down housing prices. I think if you let people build and you find a way to prevent NIMBYism, while obviously I think it's cities want to some degree, preserve culture in these things. But at the end of the day, just living in a museum, I think, is short-sighted for what's most important, which is people's day-to-day economic health. I think something needs to be done to pull apart the entrenched and red tape and all that, prevent more building.
Bull or bear on office?
I'll give the exact same retail
Depends.
prediction. I don't think it's a hard one. I think it's bull for the people who start to move. I think honestly, that's the easiest one. I think everybody agrees with that. I wish I had a more spicy take, but
Bull or bear on the market in general, the Dow, the S&P, the public markets?
I'm a bull. I woke up pretty positive today.
Nice.
Yeah.
You
So
look great.
we
So
had our holiday party last night. I had a fun time hanging out with everybody.
yeah.
I'm feeling pretty good. I think we're gonna see those tax breaks kick in.
Mhm.
I think whenever the market hits the top over the last like 10 years, I've always gotten nervous, and then I don't know, it continues to push forward. So I really like I was skeptical at the beginning of Q4 of the adoption curve on AI to the end user, and my skepticism is fading. Like it's just amazing what this stuff can do and how fast it's getting.
Yeah.
It's crazy. What's your call?
I'm positive. I'm positive. I think that my next question for you is bull or bear late stage SaaS, but I'll take that one first and then I'll hit that with you. I think the market, I think everybody's ready. I think there's a lot of dry powder on the sideline. I think it's going to be a really good year. I think we've been waiting for the sun to come out. Everybody's been watching the economic indicators. And I think 2026 is the start. Does it mean it's going to be a massive run up? No, I don't think there's going to be like exponential changes. But I think the talk about is everything overpriced? Is everything overvalued? Is the stock market just hollow and flimsy and just continuing to run price? No, I think the foundation is there. And I think we're going to really see the capital markets put more money to work. And that's why I'm bullish. I think the money's coming off the sideline and it's going to go back to work.
All right, so late stage SaaS.
What's your take?
You said you were gonna go first.
I'm bullish. We're back. We're back.
I think
Valuations back up, exponentials. People are going to be trading on 100x revenue. No, those days are over. I think that like in most markets, I think everybody jerks the wheel a little too much when you correct. I think it was right to obviously correct. I think it was good. I think the discipline and accountability on health of these organizations and balancing sort of profitability with growth was really good. I think we got a little ahead of the skis back in, call it 2022. But I think late stage SaaS is going to have a comeback. And the other reason for that, I think the IPO market is opening back up. We're seeing a handful of companies file. You're seeing companies like a Discord quietly filing. You're seeing like what would be a SpaceX. You're seeing some of these really late stage SaaS companies or late stage software companies, tech companies, whatever it may be, start to go public, which is a great thing. You're going to have more liquidity in the market. I think that'll also free up M&A.
I do think we're going to see M&A come back. I think the administration is smart enough to know that we need healthy M&A for healthy innovation economy. Like if venture and these people can't get good capital returns, not everybody can be a trillion-dollar scaler, although I think more and more continue to prove that, particularly with AI, we'll see that number grow, just like we saw technology companies after the dot-com prove that the markets are bigger than I think people predicted. So I think the number will continue to grow, but you still need healthy M&A for those kind
Yeah,
of used to be billion-dollar exits. I think that kind of category needs to open up. It's probably going to be that like 5 to 10 that gets too much scrutiny from the government now. So I think that would be a huge unlock. And I think the SaaS category also comes down to the same thing office and retail comes down to is a pretty hard divide. I think the people that do the work to uh, essentially rewire themselves to be predicated upon what AI is going to unlock will use the distribution mode and the customer relationships that they have to start to compound growth again. I think if you're not doing that, you're going to be like an old school mall. Sorry for you because I know you love old school malls, but
I do.
I think 2025 essentially comes down to whether it's cities, buildings, tech companies, whatever it is. I think it was a stress test year. So some adapted, some stalled,
Some
and
broke.
yeah, and some are just becoming obsolete. And I think it was a sorting year, is how I would describe it.
Ooh, when I hear that, I think about the sorting hat.
Yeah, Potter.
Sorting hat.
For sure.
Potter. Bull or bear HQO?
You really asking that?
He's bullish, folks.
It's 2019 again, guys. We're back, baby. We're back.
Come on. I just wanted that clip. Of your
That's
excitement.
what I was talking to this week. I was like, "How you feeling?" I think we're back, and they were like, "Yeah, this is back."
Let's go.
We're
Excitement. Couple more, and then we're going to wrap up. Bull or bear this podcast?
cautiously bullish.
Ooh, I am bearish as it gets. This thing is on a
You gotta
free
get guests
fall.
coming on. Do you get to talk about the guests? Come on. You're just insulting our soon-to-be guests.
No, we'll talk about that. I'm bullish, obviously. I think this would be a good year. This would be a good year for the show. We got the kinks out, tried a bunch of stuff, failed a bunch of times, got a bunch of really good feedback. So that'll be fun. All right, well, let's freestyle a little bit before we end. I do want to talk geo and cities for a second, and then I want you to freestyle a couple of maybe hot takes you might have. But hottest city and city that will be left behind. And I want you to relate that to quantum cities.
Hottest is the easiest call there is Austin, Texas. I mean,
Okay.
talk about the pretty girl at the dance. My God.
Okay, fine. Okay, yeah, sure, fine. I'll let you continue on Austin, but give me number 2 then too.
It's just like I don't think anybody's close. Like I would have said Miami until DeSantis started coming out with like anti-AI rhetoric, which was so weird. But maybe Miami, so long as he stays out of it, maybe Miami, but I'll try to pick a sleeper. I might stay in Texas, and
Okay.
I think the energy companies are going to do well, so I might pick a sleeper in Houston. I might go Houston.
I like Houston. My hottest, Reno, Nevada.
Ooh, good one. I like that pick. That's a good one.
I think Nevada's going to explode. Yeah, I agree with you. Austin, All In talks about it. Joe Rogan talks about it. There's a ton.
They're early on autonomy. It's business friendly.
Yeah.
Talent is going there in droves. They've got some of the best companies, like places booming. And
I think Reno.
the culture piece too. Like all the comedians that are actually funny are going
Yep.
there. It's booming.
The reason why it's like Reno is I think there's a lot they can do with infrastructure in the desert. And I think if we learn from our folks and friends in the Emirates and what they're doing in Dubai and Riyadh and so on, I think Nevada can be our, what is it, the line? Or what are the developments over there? That can be our playground.
Yeah. Neom. Yeah.
City that's getting left behind. You can't mention.
Hold on.
Okay.
Speaking of the Emirates, did you just see what the UAE did yesterday? They are no longer funding. They used to fund people from the UAE to go get educated abroad. They're no longer funding and supporting people going to UK institutions because they are worried, and this is coming from the United Arab Emirates. They are worried that if they go to the UK, they will become too radicalized by the Muslim Brotherhood.
Wow, I thought you were going to say too lazy. Ooh, just kidding. Big fan of our UK customers.
I did not have that as something that would happen in 2026.
City that's going to get left behind. You can't mention anybody in California.
Chicago.
Whoa.
Yeah, or maybe Minneapolis.
Fine. New York.
Ooh, I don't know. I think that's a bad pick, man. I think that's a bad pick. I don't think New York's so resilient.
New York, put it on a t-shirt. New York's resilient. I love that. I love that take. I hate to go against New York. This is going to sound bad. Can Jamie Dimon continue to put New York on his shoulders?
Yeah, he probably can.
You see his pay package? 2025?
No. How'd he do? I'm worried about him. Jamie needs to get his. You know what I'm saying?
Oh, yeah. Well, I'm for sure. He got his. I think it was $777 million.
Oh, phew. Whew.
So he got it.
I was worried for him.
He works. He works a lot.
Sure does.
He got some money. Okay, give me a wild card before we wrap up and talk about some plans and what we're going to do next week and some plans for the show. Wild card. Give me something interesting. Give me something to chew on for 2026. Could be anything. Could be
Uh,
pop culture. Come in.
I got Pats winning the Super Bowl.
You got the Pats winning the Super Bowl.
Yeah, actually, I'm a little worried about the defense, if I'm being honest, but I got to try. I got to stick with my bull case, so I'll go with that. We're back, baby.
I think that social media will. So I think UGC, I think user generated content, will continue to explode. I think social media, friend requests and that crap and socializing on the internet. I don't know how to measure this yet. I got to think about this. Can't be market cap of Facebook, can't be market cap of Twitter or X or whatever those are. Snapchat. I think social media is over.
That is a hot take. I will take the opposite of that for sure.
I think it's done, man. I think it's done. I want to just like I want to get rid of. I want to go back to. I want to go back to dumb phones, and I want to go back to socializing in person. I want to go back to just sending a text message to see what people are up to and picking up the phone and calling people. I want to get rid of doom scrolling. I want everybody's mental health to come back. I think social media is just a destroyer. I'm so guilty of it myself. I got myself one of them little, it was a gift actually for Christmas, a brick thing. So now I can just turn off every app on my phone for every long-standing periods of time outside of work.
What are you talking about, a brick? What are you talking
It's
about?
it's like a thing that I tap my phone on.
Dude,
and it
just
turns.
get Opal. You don't need another device. It's
Not another device. It's not another device. Well, I guess it is a piece of hardware, but you know what? Listen,
Opal.
I'm not strong enough. The pull to Instagram is so much. I can't.
Just set up Opal.
So either way, I think social media is done. I think it's had its run. Thanks, Zuck. I think we're seeing social media bans. I talked about this on one of the other shows. Social media bans for what in Australia, 16 and below.
Yeah,
I'm telling you, social media bans 40 and above. It does nothing good for my health as a 40-year-old.
I'm supportive of what you're trying to achieve, but I don't think it's going to happen. So with you,
maybe by 2030. I want dumb phones to come back, even though I just got the stupid iPhone 17 because my kids cracked my screen. Okay, that was fun. So hey, we started 18 episodes ago. It's been fun. It's been a blast. We tried a bunch of new stuff. We had 203 hours of viewing last year, 2025.
Nice.
Honestly, I don't know if that's good or bad.
More than zero.
It's better than zero. If you folks are watching, keep the feedback coming. The best thing is
our problem is that you and I both suck at social media, and so we got to get somebody who's good at that.
Which is good. We did hire some new folks.
You used to be good at it.
I used to be good at it. I was a big social media guy. That is also why I want the death of social media.
You don't have to rebuild your skills.
Yeah, social media is coming back. That's my 2026. It's simultaneously my, resolution is to get better at it in promotion for the company, but I don't want to be on it personally. What's changing on the pod? More QCI, more city deep dives, more experiential driven, more data with regards to the experiential gap. We're going to dive into Leasing a lot more. And a lot more guests. We already have guests on the schedule. Now, the thing with guests on the schedule, you know what the biggest bummer about having guests on the schedule is?
What?
We can't punt the show that week.
That was just an end of year thing. It was busy. Everybody knows. We were talking about it. December was possible, but we're not going to punt.
We're not going to punt. We got to show up. We got some awesome guests.
Are we talking about our first guest?
Talk about the first guest. And you can talk about the second guest. You know them both, I think.
My man, Steve Weichel from MIT's Real Estate Center is going to be kicking off our guest slot. So I love Steve. I'm pumped to have him on and chop it up. He's a regular listener. I'm excited to have him on. People are going to love him.
Joe Pine's coming up next. We got a couple of We got a couple of big name landlords coming up next. If you want to hear from folks, let us know. We're gonna keep it international, which is good. We got a lot of international customers, and we're gonna do a lot more deep dives on markets that are progressing, that are doing special things. It's gonna be a good year. It's gonna be a good year for the show. I'm excited. Any parting words, Chase? Happy New Year. Any parting words?
Let's go,
folks. First show of the year. Thanks for coming out.